Good afternoon, everybody, and welcome to our session today on sustainable investment. I am Susan McCormick, and I have a fabulous panel that I'm very pleased to be presenting with today. First, we have Anne Finucane. Did I pronounce it right?
Yeah.
We have Clifton, otherwise known as Cliff Gibbons. And I'm looking for my notes. I'm sorry for a second. Hold on just a minute. Then we have Vicki Fuller, and we have Scott Minard, and I've been practicing for this all afternoon. We have Markus Voigt. Did I get it right? Okay, very good. Welcome. We're going to be talking a little bit today about sustainability, and I thought it would be good to first define sustainability and sustainable investment, because that term, like a lot of other terms, often gets confused. And so first, when we talk about sustainability, really we are focused on issues related to ESG, environmental, social, and governance in companies and as investors are investing in companies. And particularly when we're talking about investing, we're talking about long-term. Sustainability is often attributed to environmental sustainability or climate risk particularly, but it can cover a broad range of factors. That is usually distinguished from ESG being environmental, social, governance, and leadership. And ESG is really, I gave you a couple actually of definitions from SASB. We'll get to SASB for a second. It really focuses on specific elements, and really elements related to environmental and social and governance that are, many people believe, material to operations. So that brings me to my third slide, sort of how is this distinguished in the market from impact investing? And I really think if you asked, 10 different people or the 100 people in this room what impact investment means, you would get 100 different answers. Because in fact, impact investment really means three different things. Some of impact investment is called sort of impact first investment. It's an extension of philanthropy. Other impact investment is really investment first, driving for returns. But as Vicki does and a lot of people on the stage do, people who honestly believe that if you focus on ESG factors, you will in fact have better returns. And then in the middle there are sort of catalyst investors. And those are folks that are looking at impact and returns and particularly driving investment in renewable energy and infrastructure, which are some of the things that Markus Voigt is going to be discussing, if I'm getting it right. So that's kind of how we set the stage. And before we talk with the folks on the stage who invest significantly in this area, I thought I would introduce you to a couple of the different mechanisms and new things in this market that have been evolving. And first, we have a whole bevy of corporate forms. We have people who are playing with traditional forms so that they are embedding ESG or sustainability within traditional corporations. Second, you have a rise of hybrids or tandem forms where nonprofits and for-profits are working very, very closely together. And this is, I would say, sort of your grandmother's 1% foundation where you make your money and you give it away on the side. That's now 10 or 20 years old. People are really focused on how they can use nonprofits in a way that expands their commercial viability. Actually, people out of the nonprofit world talk about sort of, grant capital, non-dilutive capital coming in to build out parts of the market that aren't viable for mainstream capital. And then there are new corporate forms. There are a lot of them. People confuse them with B Corps. A B Corp is just a certification model. But of all the new corporate forms, one of them, the PBC, the Public Benefit Corporation, actually backed by KKR, that was Cliff's old company, has filed to go public. So they're in the public markets. And the ones that work, the PBC and the SBC, are actually shifting the fiduciary duties. So they're actually managers and boards of directors of those companies have a fiduciary duty to shareholder agreed goals in addition to shareholder profitability. So this has gone mainstream very fast, and these are some of the sort of cutting edge tools that are being used. On the fund side, just to let you know, some of the more innovative funds are also playing with term and compensation and measurement, benchmarking, and reporting in a way that can focus on impact and returns. We also have a lot of debt and equity instruments. The ones on the left of your screen are those that are being used by mainstream capital, like Tom Steyer's group and TPG Rise, and the ones on the right are an extension of philanthropy. But all of them are blending impact in with, in some cases, mainstream returns. And finally, you have what's important in this is if you're going to invest in my fund or invest in a company, I'm going to focus on impact. I really want to report to you and benchmark in a way that looks like financial returns. And that's sort of the bottom category. Right now, the world is divided in sort of mandatory reporting, which already required in 10Ks and 10Qs. You have voluntary reporting on these factors, which are people's CSR or GRI reports. And increasingly, you have a rise of integrated reportings, where folks are taking the ESG factors that are material to operations and saying, no, these belong in reports and need to be measured and reported to investors the same as financial returns. So with that background, I'd really like the panel now to take a couple minutes, and starting with you, to talk about sort of who you are, what you're doing at Bank of America, and specifically why you and Bank of America are focused on sustainability and ESG as part of your mandate.
Well, thanks. I'm not sure that I can follow all of those slides, by the way. I hope everybody, we're not going to be tested on this after. For us, it's a matter of a big corporation that had the opportunity to sort of reset itself a few years back. Obviously, the financial institutions had some real difficulty, and we had many constituencies that wanted us to improve our performance in any level of consideration. And so what I mean by that is from a social perspective, from a governance perspective, and from a performance perspective. And we decided to just integrate ESG then. I mean, we were in a rebuild mode, so we integrated ESG at the same time. Environmental, social, and governance for us was to invest in environmental business, which we can get into in a minute. Social was a social contract that we had with our clients, our shareholders, and our own employees, so the kinds of just employment practices we would develop over that period of time. And then governance obviously was what kind of company we were, how we would be evaluated. And in fact, for us, we report on all those levels, mandatory, voluntary, and on an integrated basis.
That's great. Thanks. And Cliff, Robbins, and one of the things I'd like you to talk about is your career, because you came from sort of more mainstream private equity, and I believe you're the founder now of a fund that is investing specifically for ESG.
Yeah, so before I started Blue Harbour back in 2004, I had spent almost 17 years as a partner at KKR and General Atlantic, so I came from the private equity world. And our fund, Blue Harbour, we call it a private equity approach to the public markets, which means we take large stakes in public companies with the support of the board, backing management teams, and then get involved like a private equity fund to try to drive value. And I've always considered myself to be a responsible investor, and the types of companies we've been investing with since 2004 have largely been companies led by good people with, I would say, good ESG profiles. And about a year ago, after looking at what we've been doing and seeing and hearing from my clients and developments in the field, we decided to just up our game and fully integrate ESG considerations into our investment process. So that means when we meet a company, we meet a board, we do a diagnostic on their ESG profile, we identify the issues that we see that are there, we do the diligence, we assess the risk, and then, because we own 5 and 10% of these companies, we hold the management teams responsible for making progress where progress needs to be made. And I'm excited about this. I think it's a sort of new paradigm to smart investing, and I see it as a significant way of reducing risk.
And interestingly, and one of the things you won't hear, I think when the term sustainability and impact is often used, people assume that we're referring to concessionary capital. But as you're going to hear on this panel, we're not. And in fact, the investors are looking at this space and investing because they believe it is good short-term or long-term business. And on that, Scott, would you like to share your perspective from Guggenheim?
Sure. Well, Susan, I've kind of gotten tired of talking about sustainability because in a lot of ways, I think it's become a new buzzword. It's amazing to me to see a lot of the industry I'm involved in, asset management, where people are all of a sudden just launching sustainability products because, they want to have something to show people that's about sustainability. So, we've been doing a lot of work at Guggenheim in terms of really trying to define what sustainability is. And one dimension, I think, in sustainability that most people lose in the dialogue is the sustainability of the investment itself. Meaning, in terms of the capital you're putting to work, is it not only meeting the environmental goals, the social goals, all the other things that are important, but is it going to be something that in 10, 20, 30 years is going to still offer a good return to the community and to investors? And so if you have your clicker there, I'm holding Susan hostage by giving the next one, by bringing my own slides today. This is something we've been working on with the World Wildlife Fund. That is to develop a sustainability quotient for projects such as infrastructure projects and new investments that are going into place, so that when you make the investment up front, you actually have a rating by a recognized organization that tells you, is this project ticking the boxes, and to what degree is the project ticking the boxes? Now, this will probably take us a couple of years to work through, but one of the things people said is, well, this is a great Guggenheim product, so you can go out into the world and advertise, well, the WWF says this has got a great quotient. But actually, in the process of doing this with the WWF, one of the things we want is to have an open architecture, so everybody can have the opportunity to go and have their investment rated. And does it tick the boxes, not just from the standpoint of the environment, but it's the social impact, the financial impact, and in relationship to good governance. So we're trying to really build a box around the system so that it's not just Guggenheim's opinion that this is a good investment from a sustainability standpoint, but there is a third party out there that will actually tell you to what degree it is a good investment.
And eventually be able to benchmark. One of the interesting things for those of you who've been following BlackRock, I think they get a lot of press for their impact fund, and they get a lot of press for what they're doing, what's deemed sustainability. What's really interesting is that they have, you guys have seen, they have an ESG output neutral hedge. So one of their theories when they really embarked, they took the red pill and got sustainability, was that some of the companies that are the most output positive, in terms of solar renewable energy, weren't actually very good internally in terms of ESG. And so it was just fascinating to me when they did this, and that over the long term, that's why they don't perform as well. And so then they don't generate the returns for investors, but they also don't have the positive long-term impact because, and so they had in their ESG hedge that some of the companies that are kind of the worst for the world in terms of tobacco and casinos and otherwise are some of the best run. So it proves your theory. So Vicki, you want to give us your perspective from mainly from the LP perspective?
I'm glad to be here with you. New York State Common is the third largest pension fund in the country. We're at about $190 billion, and we invest on behalf of 1 million or more employees and retirees and their beneficiaries. And a large portion of our portfolio is passively managed. Probably 80% or more of our equity book and most of our fixed income is passively managed. And obviously for the alternatives, we're using active managers.
May I speak to you about your fixed income portfolio?
Yes.
Sorry, excuse me.
We had a lot of fun preparing this panel, which is why I wasn't prepared when I got up here.
You'll have to get in line, by the way.
Here we go. And so for us, sort of the integration of ESG factors or sustainability is the way we make sure that in our quest to generate returns for our present beneficiaries, we're not sacrificing the ability of the future generations to have those returns. So we have always been, even way before I got there, an active shareholder. But a few years ago, we turned the lens more on ourselves and participated in the Mercer study to get a sense for, under different climate change scenarios, how our overall portfolio would fare. And we learned a couple of things. One, because of initiatives that we had engaged in the past, our emissions, or our carbon emissions, were about 15% less than our benchmark. But we also learned that given our large weighting in developed equities, to the extent that there came about regulatory policies or changes that we were vulnerable. And that led to our creation of an index that we would internally manage. It also led to us creating or codifying for the first time sustainability principles, which dictated or guided how we invested. And at the same time, we announced that we had an additional allocation of about $1.5 billion that we wanted to target to the strategies that met our sustainability principles.
Great. And as we move further east, we have Markus Voigt, who is from Düsseldorf and joins us, really focusing more on the renewable energy and project side in terms of building out sustainable investment. Tell us a little bit about you.
Thank you, Susan. So my name is Markus Voigt. I'm from AREAM, which is an integrated asset and investment manager based in Germany. We are focused on the renewable energy sector since about 15 years now. And we followed up the German Energiewende until now, and we are a strong supporter of that. And in addition to that, we've just settled a new investment in energy efficiency, which will be one of the major investment themes in Germany for the next few years, I believe. And with our asset management company, we've started in Germany, Italy, around Europe, and just moved the last 2 years more focusing on investments in North Africa or in Asia, just to bring proper additional returns to our investors. To give you an idea, for our German really super conservative investors, the long-lasting funds we offer at this stage of the market are only able to produce around 5% as a return. And the demand is much higher. So we moved to North Africa, and we're happy that we found a strategic partner, which we've founded a joint venture with Glex AG, who is having this fabulous lounge outside. And together with them, we are focusing on North African states just to develop hybrid systems out of solar and battery. And if you do that, you usually can follow ESG criteria. It's obvious that, of course, what we do is that we have the climate change as an issue, that we save greenhouse gas emissions. But what is more important, especially in these North African countries, we employ about 2,000 to 4,000 people for a longer time of period for the security, for the maintenance. We establish training centers for them, educate them, and this all is part of an ESG criteria, how we implement it.
Great. So I'm going to have a couple questions for each of the panelists. And Scott, I'd like to come back to you. You explained sort of the framework that you've been working on developing for measurement and really allowing for benchmarking and how you define sustainability, which is key so that it just doesn't get lumped with everything else. But where, from your perspective, where are you seeing the greatest opportunities right now for Guggenheim and for investment, for focusing on returns and ESG?
Well, interestingly enough, I prepared a slide on this.
And will I find it for you?
The last one.
Okay.
So, so this gives you a sense of where we see the best risk return in the world. And so, at this point, you can see that Arctic infrastructure is one of the highest returning asset classes with the lower volatility as opposed to emerging markets infrastructure. So, what we've been trying to do is look for opportunities in the areas of ports, transportation, renewable energy, things like that we think you can actually get an attractive investment return on, and that have lower risk attached to them. So, for instance, we've financed a number of peaking plants that are related to solar fields. Mm-hmm. So that's been an interesting investment for us. One of the things, though, that a lot of the people I talk to as clients, they immediately, when you start talking about ESG, people see that as giving up return to do social good. And that, I think, is one of the biggest challenges with this whole asset category, because the minute you lead with that or you lead with sustainability, the bubble over our client's head is, okay, this means this is a lower return asset. And to Markus's point, actually in my world, and I think Vicki probably would agree with me to some degree, 5% looks like a pretty nice return in some asset classes these days. But trying to find opportunities that give you long, stable returns that meet the target objectives, I think is the place to be looking right now.
Is the key. And I would love to follow up then with Cliff, because Cliff, you have been, I'm going to go to another slide because I can, and not one of Scott's.
Not one of mine.
And really talk about, you've taken this sort of this focus on ESG really to the public markets. And I know you guys take minority positions in companies. And how do you've seen sort of how I guess came up with some examples in ES and G, but you described why you focus on it, but how do you try to influence, particularly behavior of companies as a minority shareholder?
So when we meet companies before we invest, I mentioned before we put them through a diagnostic to determine what we think are the key ESG issues facing their company. Every company is different, but obviously a huge thing for us is human capital. I mean, most companies we're investing in, the culture they have, what do they feel about gender pay equality, opportunities for advancement for women and people of color, women and minority on their boards, safety records, the health and wellness and fitness of their employees. Companies' attitudes about this tell you a lot about the quality of the people you're investing behind. And I've come to a view that if a company is not properly assessing their risks in this area, it raises a question in my mind, what risks are they assessing in their day-to-day business operations? So I really do think that, it's and I don't agree for 1 second that this is a way of sacrificing return. I think we're going to enhance returns, both from risk mitigation and from improving outcomes. But the way we're doing it is through direct engagement, with the board, with the CEO. We bring in experts when we need resources we don't have, and this is a tool like all other tools we use. We're analyzing the company's cash flows and their business position and their barriers to entry and their product and all the things we normally would do in our typical, private equity valuation approach. Now putting companies through an ESG lens is just another way and another important way of evaluating a company's risks and opportunities.
I think that's exactly right. And I think it's important also to think about the fact that there are sort of I divide the companies into two categories, sort of output positive, which is when people think about sustainability or impact, they think about those companies that are producing a good or product that is good for society. So they're advancing, solar or renewable energy or energy efficiency. But in fact, ESG, you would agree with me, ESG is critical for all companies, whether they're coal producers or furniture makers.
Exactly. And we're not, just to be clear, doing impact investing. We're not looking for companies whereby improving their ESG profile is why we're investing or the way we intend to make money. This is fully integrated, and every company we're going to look at, we're going to assess this. There are going to be some companies whose ESG profile is so poor we wouldn't invest with them at all. There'll be the great preponderance of companies where ESG profile is acceptable, where there's things to do. And there'll be some companies where the ESG profile is troublesome, but we're going to take on the responsibility as their lead stockholder of driving change.
Of improving it. And again, the BlackRock ESG output agnostic hedge is an interesting example because it has been driving quite high returns. So Anne, I'd love for you to talk a little bit from Bank of America's perspective, particularly about your Catalyst Finance initiative, and maybe tell the audience a little bit about what that is, but how Bank of America is really using this and using some pretty innovative means to deploy capital, again, not as concessionary capital, but both for returns and for positive impact.
Right, and sort of to play off of what both Cliff and Scott have said, I think the first thing we looked at is what kind of company are we? And I'm not saying these things happen exactly at the same moment, but 30% of our board are women, about 30% are diverse, 40% of the executive management team are women, and 43% of the company is diverse. So with that base, we had made a commitment to $125 billion ESG commitment by 2025 in order to make that happen, and we're already at almost 50 billion, but at the time, making it happen, we felt we needed another conduit. So we developed this catalytic finance initiative. It's $1 billion from us and $8 billion or $7 billion from 8 other financial institutions, but not all banks. So it's banks, it's private equity, it's development banks, it's private investors, and the idea of venture capital. And the idea is on a combined basis to look at deals so that we could de-risk the deal enough to make it attractive to lots of people. And they're not all the same deals. Sometimes it's structured debt for Solar City, and you evaluate the return on actually being able to reduce the electric bill for the consumers or the commercial enterprises that are putting solar panels on. But it could be something, issuing a green bond. Issuing a green bond is great, but it is a little bit, in the short term, there is a little bit more cost to that. So the return on that might be, we just did one for 2.1%. It was for, I think it was for the city of Los Angeles, on the city of Los Angeles to change all the lighting to LED lighting. So it's not always as attractive as some other bonds, and there is an element of extra oversight in terms of monitoring the outcomes. Issuing green bonds, underwriting green bonds, doing it. We just did a deal with IFC, the part of the World Bank that does the private-public partnerships, and that, I think, will be a reasonable return. But part of the return, and we were a book runner as some others were, the return will be measured either in cash or you can take it in carbon credit, which at the moment may not be important, but we think on the longer term may be.
And some of the structures that I talked about in terms of the debt and equity instruments that the Bank of America is using is really exactly, it's capturing, it's almost looking at some of this value, at the future value, and capturing it in terms of royalty payments, that if and to the extent it has, so you do know the structuring terms that I talked about, if and when it does have value in the future, it will pay dividends back to the investors, and that's sort of capturing the environmental side.
Well, just one thing, you had asked about how it's measured.
Yes.
At least you did back in the, so we do, I mean, it's the same measurement we're talking about, which is we measure it ourselves, we measure it, E&Y measures it, and of course there's the financial measurement. But one last thing I just wanted to mention, that our equity research group has done a report on ESG. Does it matter for corporations in the longer term? And they can show pretty definitively it does in terms of lower bankruptcy, higher return, less volatility.
And in terms of, before we turn to Vicki, in terms of measurement, benchmarking, and reporting, it's still early days, but Guggenheim, there are a lot of people that have done an incredible amount of work. And again, it is digesting. The data is there. There's a lot of data out there. It's how do you figure out from the data that's out there what is really material to a company, so we can get out of, 95% of reporting is in that middle category. People sort of pick and choose. You want to present the best about your company and your investment. And so you don't have a way to benchmark. Is X amount of carbon emission reduction good or bad? Well, it depends on how everybody else in your industry is doing. And the move to integrated reporting, and I just want to shout out the Bloomberg Carney task force, particularly on issues of climate risk, has really gotten out in front in terms of figuring out how companies can report, not just, again, on carbon emissions, but carbon risk. And in terms of reporting, Bank of America is further ahead. A lot of, with TPG about a year ago, we did a presentation East and West Coast to private equity funds, and 95% of them were there to figure out how they could check the box and whether or not they could assign on to the principles, and how they could appease some crazy European LPs who wanted them to talk about ESG. And one of the questions I was asked then again was, in fact, we've been investing this way. We know we have a fiduciary duties as asset managers. Are we going to be breaching our fiduciary duties if we change our focus? Vicki, I'd love your views. I'm hopeful that people will start asking me if they're going to breach their fiduciary duties if they don't actually focus on these ESG factors. But what are you're investing in a lot of these asset managers? So, I mean,
fiduciary is a relationship of trust, right? We're the beneficiary. Any asset manager that we decide to go in partnership with is a fiduciary to us. But let me give you an example. On the private equity side, if we're investing with a general partner who is going to engage in horizontal drilling. It's very important for us to understand, and we actually have a side letter that we require them to sign on, that the practices that they're going to employ are not going to be destructive to the environment. We've had situations where GPs say, we won't sign that letter, which for us says you're not willing to be that fiduciary for us, and that is absolutely fine. We just won't form a partnership. Because ultimately, we're investing for people that are going to be retiring in 30, 40, 50 years. And it goes back to Scott's point about the investment itself. If you end up with litigation or regulatory fines or penalties, that strategy that we went into with you is in jeopardy. Now, stepping away from direct investments, we don't, these are early days. We understand that there is a lot of information we don't have. For example, this index we created relies on CDP data on emissions. Many companies don't report that data. So as important as it was for us to create the strategy, we used our engagement strategy to call upon our shareholder companies to report the data so that we would have accurate information. And it's early days, but it was interesting. In the year since we launched the index and started engaging, 40 companies agreed to start providing the data. And so and that's fiduciary to us as well. The last thing I would say is we have seen that when we educate GPs about why this is important to us, why sustainability is key, what we're trying to accomplish, 99% of the time they come around. We're not asking people, it's not a check the box, it's not you're a signatory to UNPRI, that's great. But we're really interested in how you think about investing, with the E, with the S, and the G, so that there's no guarantee that the strategy will be successful, but we don't want to have the law of unintended consequences that come from not having an ESG perspective.
Got it. And back to, Scott, this is off script, but in terms of when you've built out your model, we heard CDP data, a lot of folks that I work with have sort of settled on MSCI data. Do you know what data you guys are using? I mean, there's so much out there, and the people are trying to parse through and figure out how you need good data to be able to, across industries, to be able to benchmark to see if people are having good performance.
Well, at this point, we haven't really landed on anything in terms of how we're looking at this. We really started out with the WWF on a blank piece of paper. One of the things, though, that they want to take into account, which I find interesting in relationship to what Vicki was just talking about, is remediation cost. A lot of projects end up having remediation costs well in excess of what it would have cost to address the issue up front. So I think we're looking at a lot of things other people haven't taken time to look at. And so at this stage of the game, we're letting them sort of take a leadership role because they want a partner who actually invests money, who will work with them to understand what are the issues in terms of what investors have to face. I think that we're going to find out that the WWF comes up with a lot of alternative standards to evaluate things with.
Good. And one of the dangers is that you have it's why I've been following the task force work, is right now if you're a company in the US, you have 15 or 20 different organizations telling you different ways you need to be reporting on this, and so parsing through and figuring out how to do it can be quite difficult. And it's important if you believe that this, as you all do, is important for your financial returns to really look at it. And it goes way beyond the US. And Markus, particularly, I'd like you to address, you're investing mainly, obviously, outside of the U.S., all outside of the U.S., and really, the issues we're talking about, all ESG and particularly climate, are obviously global. So, what are you seeing in terms of difficulties in putting together investment and financing vehicles, particularly in your markets outside the U.S.?
So, if you're investing in developing countries, of course, it's quite a challenge to get a proper refinancing in place.
I'm gonna put your slide
So we usually see that we start investing equity only in our structures, and we try to convince investors to follow us, and also ESG discussions help us. What we do is supporting areas where we have a leak of electricity, where we can install off-grid solutions because of the well-developed new storage facilities. You can combine solar with storage, and you can offer proper electricity to an area where they usually don't have any access to daily electricity, which is really a big support for these areas to develop in the future. And this is really an amazing investment we do. And we're happy that we have identified investors who are following us. But there's really a leak of getting these investments refinanced. What we plan for in the next stage is that we structure project bonds, what we did in Europe, also for developing countries. And the strong belief is that because of having ESG criteria just implemented in the way we structure our investments, and by offering finalized projects as a really infrastructure project in special areas, there will be a success to placing such project bonds.
And do you want to address Scott's slide?
No, I won't. we had a discussion in the beginning, and I was wondering why investing into infrastructure in developing economies isn't as good as in developed economies, especially the story I've told you about implementing a small off-grid system for an area where we don't have electricity by now is such a huge impact on the growth of this area that I don't believe in this figure, sorry to say.
Scott, would you work less like to rebut?
Would you like to put the slide up again so everybody can see it? If we're going to have a
I'm trying.
If we're going to have a controversial discussion, let's go for it. Right. As I explained to everybody there, I don't know the answer because it's the IMF's data. It's not mine. No, but one of the people who've worked on this for us internally, Matt Bush, Matt's here somewhere, I think, it pointed out to me that the impact on infrastructure spending in the developed economies is greater because of the output gap in the United States and elsewhere in the developed world. So I think that if you believe that argument, that this is a point-in-time question, meaning if we make the investment today when the output gap is so high, the opportunities to increase productivity through infrastructure spending is probably higher than it is in a lot of the developing economies. Because while I do agree with you, it's a big impact. The problem is...
A macroeconomic view might be different to my story of implementing a grid for
I was gonna say,
one individual area.
The impact in one community can be massive, but at a national level, there's probably more opportunity in developed markets.
And Cliff, you wanted to add?
I wanted to make a point back on the reporting and measurement, because I think that's the big issue generally. And I've been frustrated by that because we're investing in the U.S. in small mid-cap companies, $2 to $10 billion companies. And these companies do not have a chief sustainability officer, do not have good reporting generally. MSCI covers some of these companies not particularly well. And so there's all the more reason why there's more to do there, because these companies need to make progress in ESG and they're not really being held accountable. So from my standpoint, that's another reason why we have to do it ourselves, in terms of meeting with the companies, doing our own diligence, holding them accountable ourselves, and we'll be judged based on the returns we deliver to our investors. But there really isn't an independent yet verifiable reporting system generally in small and mid-cap land for how companies are doing in this field.
Well, the one thing I would just posit, on climate, you've got the Bloomberg Task Force, SASB. For those of you who have not heard of it, that is the Sustainable Accounting Standards Board. Sort of think FASB, but for sustainability, really has gone industry by industry and gathered data from investors and companies to really figure out what is, sort of parse through the data, what is material, so you can have some consistency and overlay and reporting. Are you looking at the SASB?
Yeah. And another thing I would say, we didn't comment up yet on this panel about this, a huge change that I've been just feeling in the last year, and it's sort of palpable, is how this whole subject matter is now a lot more interesting to a lot of constituents.
Yes.
I'm hearing about it from my institutional clients, from the university clients, because the students are going to the university boards, they're concerned about it. The pension funds, millennials care about it, family offices. I mean, I just think that this is, for a long time, this was something that people paid lip service to and companies saw it as an annoyance. That's all changed. And I really do think that 5 years from now, if we have this panel, there'll be the rare manager who's not considering ESG considerations into their investment process. And I really think that it's a big change.
I'm hopeful. I'm going to open it up in a minute for questions. So if you guys have burning questions for the panel, you can. But I would love, starting, Anne, with you, for each of you to sort of, if we're projecting out, Cliff was talking 5 years, what do you think is kind of the most innovative that you're seeing right now in terms of new financial instruments, in terms of people who are, again, not deploying concessionary capital, but really investing both for the positive impact and the returns?
Well, I would say that what I'm the most enthused about is the new partnerships that are happening, that are for real, that are sitting down, figuring out a deal, figuring out who's going to take what part of it, what is the long-term outcome for that. I am a little frustrated, like the others, about who's measuring what. I mean, it's an alphabet soup right now, and we are in, GRI, CDP, MSCI, so on and so on. And there does have to come a time, other than what the true results are, that we can all agree. SASB's a start, but it's early.
That's right. Cliff, what do you?
I'm excited about the changing attitudes I'm hearing amongst companies. When you go meet with companies today and you explain to them why this is important and they can do well and do good and it's good for their people and good for their shareholders and good for their constituencies, they're open-minded to it. And I really think that, I'm excited about the receptivity there. And just speaking for Blue Harbor, I'm energized, about the way it can help us both reduce risk and improve returns.
I'm hopeful. I'm hopeful it's not, it's there. I mean, there is quite a bit of greenwashing out there. I mean, you can, without the ability to really measure, a lot of companies can say that they're great with a lot.
Yes, but you have the millennials coming up who won't allow for it. So
we're hopeful. Scott?
Well, I think that, I don't know if I'm excited about it, but I think that...
You are excited.
Yeah, well, yeah. I think companies are going to get punished. So I don't know if I'm excited about it.
Okay, no.
But, when you look at...
Wells Fargo, yeah.
Well, I don't know. But you can say that because Bank of America's on the stage.
Yeah. I was pandering.
But, when you look at, for instance, one of the things we talk to our clients about today are utilities. And, a lot of people don't realize it, but in general, it's cheaper now to generate electricity by using solar than it is to use a traditional oil-fired power plant. And the problem is this solar technology gets better and better. Mm-hmm. It's a challenge from the investing side, because where do you invest on that spectrum today? When you realize that what you're investing in today, if you invest in a solar array, in 5 years that solar array is going to be highly inefficient relative to the options then. But taking it from the other perspective, pension funds, insurance companies, people who have traditionally been providing capital to utilities are going to find out that these industries are going to get stuck with a lot of stranded assets as technology is changing around them. So, I guess if I were, wanted to be a hedge fund, I could start getting short utility paper right now. So there's something to be excited about. But I think that where you get on this wagon for a lot of the technological change that I think is going to drive a more interest in sustainability is an interesting challenge, and it's going to be a great opportunity for people who can get it right.
And we didn't talk about it, but stranded assets reminded me, Generation Investments has been in this space for quite a while, and they came up with a fabulous, paper now, I think almost 10 years ago, on valuing stranded assets. And again, not looking at it as, this is, let's think about climate, it's a bad thing, that's part of it, but really, how do you evaluate it from a financial perspective, because, they are stranded.
That's right, and one of the things, we talk about climate change, and look, I'm very concerned about climate change, but I don't want to make light of it. But when the argument becomes, would it be better if I painted my house with a solar paint where I could get my energy cheaper than by paying my local utility, it's going to drive an entirely different set of logic from investors than what we're getting today. And so I think the exciting opportunity here is that we may find that the efficiencies and economics of a lot of the things that we look at today as being maybe not as good an investment longer term are going to be the things that actually drive the change for us in the future, for a better world.
That's right. And for those of you who haven't read him, and I have no relationship with him other than being a groupie, Bob Litterman, who is a former head of the quant department at Goldman, has put out a lot of sort of papers on economic models that build in climate risk in a new way. And his premise is that all of our economic models underlying everything are wrong for specific reasons, and one of them being that we're headed to a cliff, and all the models are premised on the fact that we're going to gradually apply the brakes, and we're at some point going to have to slam them on. And how do you evaluate that risk from an investor perspective? And it's sort of getting out of the save the polar bears argument, which is part of it, but really looking at the economic risks associated with climate. So what are you most innovative, most exciting?
Well, the thing that I'm the most excited about is the change in discourse. Several years ago, we had picketers outside our offices just saying divest from all fossil fuels indiscriminately. And there was laws that were proposed that would require us to legally get out of it. So the fact that there's an answer, not maybe the answer that the adherents wanted, is important. I'm excited about seeing a lot of these smart minds create investment strategies that we can invest in. Double bottom line impact strategies where you can measure the financial, where you try to measure the financial implications, but also what it's doing for the environment. I'm excited when I see an affordable housing manager who is totally incorporating ESG into the way they make their return. I'm excited when I hear about the combination of clean technology with digital mobile technology, and particularly in the developing world, and the implications that has. So in many ways, large and small, this disruptive and innovative process is going to create, we're going to see some very different things over time. Will there be stops and starts? Yes. Now, I'm at a Milken conference. When I was a young portfolio manager doing high yield, they questioned whether it was an asset class. No one talks about that anymore, right? So I'm excited about all of it.
Great. Markus.
So following this discussion and regarding what will happen with the solar, when we've started and did our first investment, it was about 13 years ago, we've invested about 10 million euros per megawatt installed capacity. We are now down in Germany down to 600,000 euros per megawatt. And this is only over the last 12 to 13 years. That gives you an idea what is happening in this market, and this development hasn't come to an end right now. In addition to that, we see a developing technology in the storage arena. And at the moment, storage is quite expensive. It's about 8 cents or something to store 1 kilowatt hour. But although this will come down in the near future, and there we will see so many new business models all over the world, and this will have a tremendous impact on the whole production of electricity. Also wind. We had this last auction in Europe in offshore wind, and it was the first time that there was no premium necessary on the market electricity price to get a license for offshore wind. And still, this is not the end of the story. So when I was young, I was really not sure what will happen with energy in my life when I'm becoming older. But now I'm so optimistic. If you see what's happening with these renewable energies and the power which is still in the development of these systems, I'm quite optimistic. But this will be really a challenge for the conservative old utility business model.
Okay, so we should go short on utilities. That's what I'm hearing. And I'll just say, if we think about, we'll have at least time for 2 questions. What you can probably tell, most excited about is the shift of corporate form and fiduciary duties. So if you think about a company that is now publicly traded, where boards and management have a fiduciary duty to shareholder-agreed social and environmental goals. So it's not, airy-fairy, but they can be sued on them, and they have to report on them. That is a game changer. And again, different from the B Corp, but it's working and it's out there. So my life's goal is to have Chevron convert to one of these things. Is there anybody from Chevron in here? So stay tuned for that. Why don't we do we have mics right here?
Hi there, thank you for your panel. My question is for Scott, and it's involved beyond your partnership with WWF, which is a wonderful organization. Is Guggenheim involved in any other partnerships or initiatives that could provide tools that would benefit the investor community in general? And if not, why not?
Well, it's a good question. I would tell you that I'm mostly a student of this, not the developer of tools. So at this point, we're really not developing anything else than what we're doing with the WWF. And I think that's probably just because of the commitment that we've made. This is going to take a significant amount of resources on our part alongside the WWF. I spent the last 3 years working with the World Economic Forum to develop a protocol for responsible investing in the Arctic. And again, the amount of time and bandwidth is pretty big. So it just becomes a resource question for us. But for people that are interested in it, and one of the things that Cliff was talking about, there's a great book out there called Conscious Capitalism by Raj Sisodia that gets into how to measure companies in terms of their responsible investing in their businesses and their employees and everything else. And actually, in his book, he argues that the data supports that portfolios that invest in companies that are responsible get higher returns over time, and he has a lot of data to support it. So, I'll point you to one of the sources that I've looked at in the past.
I'd love for Anne, because Anne mentioned earlier, I know Bank of America has a large number of partnerships and has been working closely with them and a lot of the folks in the NGO world. Do you want to?
Well, these partnerships they're making a difference for us because there's more than one way to measure something. And what I mean is, beyond our performance as a company, beyond the investment in behalf of the partners, the NGOs, particularly, World Bank has really begun to do some very innovative things. And with that innovation, particularly in the developing world, where arguably the risk is greater, the duration has to be longer, they are able to measure and report on a sustained basis in a way that most companies just don't. They're digging in a way culturally as well as financially, and I think that's going to help because that gives some, in terms of shareholders, at least to our bank, makes a difference. One thing I wanted to mention, because this is a very real thing. I meet with shareholders all year long, and if I've met with 50 institutional shareholders 3 years ago, nobody asked me about ESG, and today, very few don't.
Mm-hmm.
And the fastest growing category of proxies in the U.S., bar none right now, is related to, and they've gone beyond, do you have a policy on climate change, to what is the impact of your operations on deforestation, and it's fabulous. Let's have time for one more question back here. Sorry. And if they'll let me go on. Okay, we'll go here. Sorry.
Thank you. The presentation was very informative, but some of the investments with the highest ESG profile are in emerging market economies. And granted, they are higher risk, but they are significantly higher return. Now, other than Mr. Voigt, who mentioned investments in North Africa, I am thinking much more frontier than North Africa, namely Africa, where ESG profiles are massive and returns are equally massive, also with higher risk. Now, I know KKR has dipped a tiny toe in the African continent. I don't know about Guggenheim. Could the panel sort of comment on how we can bring the concept of sustainability on a planetary level rather than just in the local level?
Well, I would just say you have to have these partnerships where somebody is willing to take, or a group is willing to take a first loss, so that the risk is mitigated by some extent, because that's a big deal.
And I'm working with the Microgrid Investment Accelerator, and we're putting together a stack deck fund, which is exactly what Ann said, where you take in philanthropic capital to de-risk, so your later investors can have a higher risk profile.
Right.
And they go in, and for those of you who haven't heard of it, it is aggregating, sort of a large pool of sources, so you can also spread the risk among different types of investors. And can I have one more question, or do we need to end the session? Okay, I'm sorry, sir. Thank you very much. Join me in thanking the panel.